Okay, now, hi, good evening, ladies and gentlemen. This is Manoj Atri, your host for today. I am a real estate agent with the Remax Hallmark. Sorry for the delay. Just at the nick of time when we were about to start, the computer got frozen and we had to restart the whole thing. And just to put it back again, it took us around 15-20 minutes. So very much sorry for the delay. And we again have our mortgage expert with us waiting. And thank you again for your patience. And let's see, we can get a hi from him. And then once they are there, we can start rolling. Faisal, you're live now, sir.
Hello, sir.
Yes. So,
Challenges, but there are successes.
challenges. I mean, the main thing here is when you told me it was freezing, it was going okay at my point, but then basically what happened is because you have so many windows opened up on the computer, it completely froze, and there was no other way for me to shut it down and reopen it, because the reason is if I don't do that, then during the entire presentation we will not be able to do it. So anyway, we are back in business, slightly delayed, but how are you doing?
Good. How are you?
Wonderful. So you have changed your location too, huh?
Yes, I tried to make sure that I'm not interfering with our YouTube here. Sometimes, location
Wonderful.
could make a difference.
So let me get a head start with my monologue of the day, and then I will take it to the next level. So give me 1 second. Let me get my yes. So I am good to go. So again, ladies and gentlemen, thank you for joining, and I am going to start with my day agenda. As usual, this is what I do, and we will start with my real estate monologue, and let's give you a heads up where we are and where we are going. My real estate monologue, again, we have been trying to wrap up for 2018 and looking forward to the new year 2019, and what are the challenges we are going to face in 2019. That's what we are looking forward to. And so that's that has been my monologue from the past 2-3 weeks, and we are going to continue with this. And just to give you a heads up, this would be our last webinar for this year, and we will then meet you in the new year, because the next one is the holiday sessions are starting there, and we would like you to enjoy your holidays and take ample rest and not be stressed out, and get geared up for the next year. And so we will be walking you through lots of challenges in real estate, and I will give you my real estate brief. We will take the mortgage broker's expert analysis of info coming from the mortgage industry, and we are going to review 1 or 2 articles there, which we will walk you through exactly what's going on and where things are and where we are heading. We will also take the mortgage expert review of the credit score and report. And today, what we are trying to do here is, last year we had tried to comprehend you with understanding your credit report and score. And today we are going to walk you through a very, very powerful presentation done by the Government of Canada, and regarding a workshop on understanding your credit report and score. So that will be the main substance for today. So let's head over to the real estate monologue, and then we will head over towards the next one. So give me a moment and let me take you there. Okay, let's start with our real estate monologue for the today. and that would be, this is an article which I saw very recently today. Over 82% of Toronto's household debt is tied to residential real estate. So if anything happens in real estate, it is going to have an impact. So that is what is the gist of this particular article. All of these links are there in the description, so feel free to read more about it. I'm just trying to pick up the highlights of these ones, and so let's head towards this. Toronto real estate pushed to new highs, bringing the city debt level with it. And that is where we are finding ourselves, that things are moving to very new highs, and real estate has literally been pushed to quite a new level, bringing the city debt level with it. And because they play hand in hand, so that is where things are. In quarter second of 2018, over 80% of Toronto census metropolitan area, and which we'll be referring as CMA, debt was tied directly to the value of real estate. So you can imagine this is very, very crucial. So 80% directly related to the value of real estate. So if anything changes in real estate, it is changing the format of the entire level of debt. The high level of debt and the attachment to real estates makes Toronto the second most vulnerable in the country when it comes to high rising interest rates. So this is what the article is telling us. And if there is going to be an interest rate hike, we are going to face some dilemmas there. So that is what is the highlight of this particular article. Let's give you some more brief on this one. Toronto households owe $2 for every $1 they earn, and that is where it is getting quite risky. Toronto households owe a whole lot cash, even when slightly higher incomes are factored. So that is the gist that we are getting from the market. The basic thing here that we can we are able to understand and comprehend from this is that if the interest rates go higher, we are going to see some issues and some problems there. And let's head into the same format of this article, but catching it from a different point of view. CMHC issues warning to Canadians, and that is the reason, on the basis of this high debt level, Canada Mortgage and Housing Corporation has issued a warning. Let's go through this. The prospect of interest rate hikes is particularly daunting for residents of Toronto and Vancouver, two cities with debt levels well above the national average. So that is where CMHC is warning us, and interest rate hikes is the main issue that we are finding is going to create some problem. The Bank of Canada has made no secret of its intention to raise the benchmark rate through 2019. And even in our last week webinar, we figured it out like somewhere in the spring, we should expect a rise in the interest rates, and in order to stabilize from the government perspective. But that is where it is going to create a particularly daunting task for residents of Toronto and Vancouver, the two cities where the debt levels are very high. And that could expose many indebted households to vulnerabilities. And that is what we are trying to emphasize, and that's what I'm trying to highlight here, that we still have 4 or 5 months, and you should be able to streamline, have some extra savings in order, if anything, if you're running on a very tight numbers, you need to be very careful in the coming, because in the spring we are expecting some things to go higher. Currently, the delinquency rates are extremely low in both Toronto and Vancouver, and we are able to service that debt without significant difficulties. Now, should interest rates continue rising, this will put a squeeze on highly indebted households, and that is what we are emphasizing on. So the entire purpose from these two particular articles, that is what I am again emphasizing here, is we expect some things to change with the interest, and if you are on variable interest rates, those will go higher. If you're on fixed, you did something very good for yourself, because but there are some issues with the higher interest rates, and they will be affecting quite a lot, because a larger share of their income will have to go to servicing that debt, and that is where we are seeing that there will be some issues that will come through this. The CMHC report has an even more dire warning. Should the Bank of Canada effectuate its intention to raise rates through next year's? So the entire jugglery is going on in this particular format, that if by chance the Bank of Canada goes around and raises the rates, there are some household might even default on their loans if their incomes are not sufficient to cover higher expenses and credit charges. So in the new year, if you're trying to purchase now, have a fixed rate mortgage if you're running very tight numbers, though variables are always the best from my experience. But I mean, if the interest rates are going to rise, then you make sure you are taken care of. You run your numbers carefully there. Research has shown that recession in highly indebted countries tend to exhibit a greater loss in output, higher unemployment, and last longer compared to countries with lower debt levels. So some research format in there. Now, a mortgage broker believes that some Canadians will try to consolidate debt and even more debt. So there will have to be people will go for consolidating their debt, and that is one of the mortgage brokers' review of this. Existing households will probably need to make some sacrifices to keep up with the impact of increased monthly interest rates payments. So that is where we are again emphasizing same thing, that interest rates are in the year 2019, somewhere in the mid part or from the summer onwards, spring onwards, you will expect those things. They probably add on a second mortgage to help pay off their debt in order to stay afloat or maintain their lifestyles. So again, be careful, get geared up, and be very careful. So what debt you are taking on yourself. On a positive note, house price growth has begun to slow in a number of centers across Canada, and a large portion of it that is due to the mortgage debt. Okay, so that comes to a conclusion on these two articles, and let me give you a brief about from my the experience that we are experiencing as real estate agents when we are going and showing properties. The supply is still very lacking. The demand is high. So basically, the prices have not gone drastically down, though the volume of sale has gone down. So the prices are still, like we generally have, like between 3 and 5% every year. So that appreciation is still holding on. That is not going down. So we are not going to see that the prices are going down because the supply is very limited. The demand is still very strong. And even in the winter months, we are foreseeing that will continue. And but the main thing from this particular articles and from all this, what we are trying to explain you is, just in case if there is an expectations that the interest rates will rise, so get geared up. Be very careful what you're doing, and that would be my monologue for today. Let me head up to the mortgage broker and let's take his intake on this particular article regarding the same. Faisal sir.
Yes, sir.
Okay, so CMHC has issued dire warnings, and how are you experiencing it? So give me a heads up on this one.
Sir, CMHC is the insurance body, and looking at from the insurance point of view, it's always better to stay safe, and that's their, it's they have their take. What I see is interest rates will stabilize. That's what I see.
Okay.
And yes, there is debt, but employment is also strong. So to give you the answer to your question, I don't see much hike in interest rate.
Okay.
There may be a small, nothing drastic.
Nothing drastic. So basically, when they are telling everything, that means like only the people who are with fixed variable interest rate, they should be careful, or the ones because the fixed ones are already taken care, or like they are already safe.
Yes, fixed or safe. Yes, for until they're but variable. Yes, there may be. If there is a hike, the hike is usually in increments. And variable interest rate mortgage always allows an option to fix. So if clients feel a little uncomfortable about the rate, they have an option to fix.
Okay. So they can also be taken care of. And the ones who are in the pre-approval stage, I think so they should get their rates locked up.
It's a good idea.
Yes, and for how long is that thing valid?
Every lender is a bit different. I like to say 90, but some lenders allow up to 120. Most lenders allow 90.
Okay. So the basic thing is like, okay, we are coming to an end to the 2018, and this would be our last webinar for this year. So I mean, gist that we are giving for this year is that the supply is still low. That's what I am finding it out from the timings that I am showing properties.
Mm-hmm.
And the demand is still high. Mm-hmm. And the next one is the appreciation, the rates have not fallen below the appreciation. I mean, generally we used to see between 3 and 5% appreciation every year. That is still holding on to it. Mm-hmm. The volume of sales has gone down because the supply is down. So those things, and from the articles that we have been seeing is that the interest rates may rise, but from your point of view, even if they rise, there will be a very small amount to it.
Yes, and it will be in increments.
There'll be in increments, and
yeah,
someone can take care of themselves.
Exactly.
But I mean, when they were saying like a lot of people are going to consolidate debt, what exactly were they wanting to point out?
Over the number of years, when you have a mortgage, and if you do some repairs or so on and so forth, there seems to be an increase in the balance of line of credit or credit card or so on. And most times when the interest rates start to go up, clients tend to consolidate and have one payment rather than have a payment on line of credit to credit cards.
Okay, so basically they would like to stop the other stuffs.
Yes.
Okay, makes sense. Now we'll be requiring you tremendously today, because we are starting the second phase. That would be the workshop on credit score and credit repair. Okay, let me get a heads up there. Let me get this started. Give me one moment here. Okay, so now I am going to take them here. So today we are starting on the credit score and repair power presentation. And this is, give me 1 second, let me get something so that I can explain where this is coming from and where we had been. We had been going through the Canada Mortgage and Housing Home Guide step by step. And when we were on chapter 3rd, we had been given an idea that we should go and review the credit score and report. And so in the last 2 webinars, we had covered the understanding of credit reports and scores. We had gone through that one a bit fast, because what we were trying to do there is that we were trying to gauge some of the major points. Now this particular workshop is it's a major awesome workshop which has been put together, and let me get across so that I can give you an idea about what exactly is this workshop about. If I can get a moment here to open up the website and show them what exactly it is. Just bear with me 1 minute. Yes, I can get across and then I can explain that here. Okay, give me, I am going to go back on my, yes. This is a workshop on understanding your credit report and score done by the Financial Consumer Agency of Canada. And it's such a powerful power presentation that I will be amazed to go through and how detailed they have gone through. This is like I'm just walking you through this report. This workshop on credit reports and scores is designed to be a standalone set of educational materials that can be delivered by anybody to anybody. So this is a workshop. Now let me head you over to that workshop, and that is where we are going to be for most part of the time. Let's head there. Okay, this is understanding your credit report and credit score by canada.gc.ca/money, and that is where you can get it. The first slide is introduction. What you will learn today. Let's go through this. What are credit reports and credit scores? So this is a workshop, and it is very put together in a very easy way. Everyone can understand it and everyone can comprehend it, and that's where we are going to head there. What are the credit reports and credit scores? What information is included in a credit report? How lenders use credit reports and credit scores. So this is all what we are going to learn today. Why you should check your credit report every year. How to order your credit report and credit score. Now let's get into the nitty-gritty of this one. Credit reports can include, okay, more than one answers may be correct. So now we are going to get into this workshop. Last time we had walked you through understanding some of these. Today we are going to do some question and answers on this power presentation. Your credit reports can include your credit cards and loans, your mobile phone account, your Facebook post, and your mortgage. What do you have to say on this, Faisal sir? Your Facebook post can be there.
Well,
I like from what
I think it's more. I think it's more talking about more in the future. But yes, information has been collected from various different sources, and Facebook seems to have a lot of information.
Yes, I don't think so. They'll keep Facebook at the moment. But yes, all three of these ones, they are included in your credit report at the moment. Is that right?
Yes.
Okay. All of the above. So let's go through the answer. Your credit card and loans are included. Your mobile phone account, which we had discussed last time. Like I was concerned, why is the mobile phone account there? And you walked me through like that is the easiest way to get. Why don't you pour some thoughts on this one?
Mobile phone accounts, I've seen multiple of them, and most times I do not see accounts that are, let's just say, just a mobile phone. But let's say if it's a package with cable, internet, and mobile phone, it's on the credit report because it's, I think it's a dollar amount that makes it there. At the same time, if that cell phone is in a collection or something of that sort, that for sure shows up.
Okay.
Yeah.
Okay. So now let's head to your mortgage. So A, B, and D are included. Now let's go through a true and false. When it comes to your credit scores, the lower the number, the better. Wow. Lower the number. That would change the entire equation of getting approvals. What do you have to say on this one? When it comes to credit score, the lower the number, the better.
Well, the lower the number, you need more down payment. So it's better in the sense because your monthly payment is smaller. That's the best way I can interpret.
Wonderful take on it, like wonderful take on it. I really this one was an amazing one. So yeah, if you will have to have more down payment if your credit score is lower. And that means like it can go better because then your monthly payment is it's way too less. Awesome this one. This is okay. Let's get the answer to this one. The higher but obviously that is not true. The higher the credit score, the better. That is how the entire industry works. You need to have good credit score to get a good loan, and that is where things are. So the answer to the last one is this one. Missed payment generally stay on your credit report for 1 year, for up to 6 years, forever. Go ahead, sir. What would you take beyond this one?
So it does stay up to 6 years.
Okay.
That's what the legal aspect is.
Okay.
However, after few years of, let's say if you had a missed payment 4 years ago or something.
Okay.
But after that, you did not have any other missed payments. Lenders tend to give you an exception and overlook that one mistake you had 3-4 years ago.
Okay.
However, missed payments over and over, lenders seem to have a bit of a harder time rationalizing as to why missed payments over and over.
Yeah, so it doesn't stay for forever, but I mean, I would say B1 would be the for up to 6 years. But like when we were doing the PDF report, it says some of them are 3 years and some of them are 6 years. So for up to, so it's not 1 year, but anywhere between, I would say 3 to 6 years, or for up to 6 years would be a right answer.
3 to 6 years is a good range to expect, because some lenders tend to keep it for 6 years. Some lenders are okay to drop off after 3-4 years. So it really depends on what product it is and so on and so forth.
Okay. Let's go ahead and look at the next one. Only as long as you want them to. So someone was very creative there. for only as long as you want them to. Wow, that would be awesome. What do you have to give your intake on this one? For only as long as you want them to.
Probably someone with a bit of a funny personality.
No, I mean, yes. There is no way, like, and surprisingly, even if you call them, it will take them some time to even get it addressed.
Yes.
That is also there. Okay, so we have there is an humor element to this workshop, and that is awesome. That is very nice.
Well, credit report and credit score is not something very interesting to most people because it's
no, very well said. Yes, I mean, it's a very like a topic which needs to have some element to put some things in perspective there.
Yeah,
interesting, wonderful. Okay, so the answer is going to be for up to 6 years. That's the correct answer there. Now let's say again another true or false. To build a credit history, you should apply for every type of credit card you can get your hands on. Wonderful, that would be awesome. But no, I don't think so. That is correct. From our last discussion, when we were there with you, you had guided like have 2 credit cards and a loan.
That's the ideal scenario.
That's the ideal scenario. So in case if and what would you say to people who are carrying a few, very many which they are not using, try to close them down, or what exactly would you say?
Closing credit cards don't really help. In fact, if you already have a credit card, I would say keep them open, use them once, twice a year, a small amount, and make sure you pay them off. Because
build history for the older ones. Try to build history.
Yes.
That is where it would be. Okay. Yeah. And like let's suppose in case if someone is having too many credit cards, what would your suggestion be?
If you have like multiple credit cards, let's say 15, 20, let's just say 10, 15, something of that sort. The ones that you're not using and you've not used in past 2 years, it's a good idea to close them. But that does not help your credit history. That also does not make your credit history any less. If you don't use them, what's the point of having them? Because those credit cards, they get delivered because credit cards have expiries, and they get renewed and sent in the mail. If your address changes, so on so forth, there's some risk element to it.
Very well. Yes. In case so, just go through all your credit cards. Which ones are you using? Which ones you're not using? Go and close them. That would be the best. But we were also going through that last time. Like in case if you have older ones, try to use some credit so that your older credit history is kept there and it's alive.
Absolutely.
Wonderful. Makes sense. Okay. So, no, I mean from the expert, this is what he had given us last time. Have at least 1 or 2 and a credit loan and a loan. That would be your helpful there. Let's get it to false. To build a credit history, you need to use different types of credit over time. Okay, so that would be the. Let's take the expert take on it. Yes, Faisal, what do you have to say? To build a credit history, you need to use different types of credit over time. What are they emphasizing here?
Essentially, what it's trying to say is having just a credit card and keep using it may not be building the credit because it's only a revolving credit that shows as a history. What it's trying to say is have variety of different credit. Instead of having 5 credit cards, maybe have 2 credit cards, 1 or 2 line of credit, 1 or 2 loan.
Okay, so when they are saying different types of credit, that is where the line of credit comes in, apart from the credit card, line of credit, loan, what else is there? So you have
Those are
those
those are
are more
pretty
than
much it.
enough? Those
Yeah.
are, and
Yeah.
okay. However, you should not apply for too many sources of credit within a short period of time. Okay, very true.
Yeah.
Okay, let's go for the next query. You have to pay to order your credit report from a credit bureau. No, this is like false, because credit reports you can get it for free, but for credit scores you have to pay them, and that is where it is. Now let's ask you a question. See, so basically, Equifax, the report is free.
Mm-hmm.
The report is free, whether it is TransUnion or Equifax, both the places, the report is free, but you pay for the credit score. How much do you pay for Equifax? I mean, any rough idea there?
I think it's somewhere around $19 for one-time use.
Okay.
And if you want a monthly subscription, it's a little bit more.
Okay.
And then every month you get credit alert and so on so forth. Like there's perks to that, having that monthly subscription.
And when they do the monthly subscription, are they also checking you the identity theft that you were emphasizing last time?
You know what? There is an option for it. Mm-hmm. I have not checked on it recently, but yes, there is an option. And
credit monitoring or something.
Yes, and one beautiful thing is it gives you notifications.
Yes.
So if someone is checking your credit, it notifies you that someone has checked your credit. Mm-hmm. So it's almost like you are on an alert.
Okay. And which one is costlier, Equifax or TransUnion, or like both are similar?
You know, they both are very nominal price.
Very nominal price. Okay.
Yeah. It's
okay. So
if you break it down, it's about a week's worth of coffee or something.
Okay. Now this is a query that I keep on regularly getting from people. Here is, they saw their score is very good in TransUnion, mm-hmm. but their score is very bad in Equifax. Can there be a very large discrepancy there?
Usually the discrepancy is not too far off from each other, but I have seen times when that has been the case. So I'm not surprised when you say this to me. It's usually one or the other is not fully up to date.
Okay, so there is an update issue that is going on. Otherwise, there should be, because it's the same information reaching there.
Yeah.
Okay. You don't have to pay when you order your credit report by mail or phone. If you order your credit report using one of these methods, you will get it by mail. True or false? You don't have to pay when you order. You don't pay whether it is by phone or mail. Is there? You'll get it in the mail. Yes. Okay. Let's get. Okay. walk us through on this one, Faisal.
Yes. So so Equifax has and I'm sure TransUnion has something similar as well. I've had clients call the hotline, and as long as you go through the options, you get the credit report mailed to you, and that is absolutely free.
So whether you're ordering by phone or you're doing it by mail, mm-hmm. you can get it for free.
Yes.
And I have also come to, like, lots of people have gone to their offices and ordered it there. Is that?
Yes.
Can that be done too?
Absolutely. Xerox Tower, I believe.
Okay.
It's very close to Young and Finch. Don't quote me on Xerox Tower. It may be another tower.
Okay.
But it's very close to Young and Finch subway station.
Okay. So and you can even walk there and get it addressed.
Yes.
Okay, so basically, but the report is free. In the end,
Yeah.
the report is free.
The report is free.
Report
Yes.
is free. That's what we are emphasizing on. You do have to pay to get your credit report instantly online, and you usually have to pay to get your credit score. Very true. That is absolutely true. Let me get a heads up from. So yes, if you want it instantly, whether it is online, then you have to pay for it.
Absolutely. It's the convenience that you're paying for.
It's the convenience. And like in your experience, how long does it take to come by mail?
Not long. About 2 to 3 weeks. Not a whole lot long. It depends, of course, on the speed of the mail, where you're located, so on and so forth. But yeah, not long.
So if you want it instantly, then you can easily check it through Credit Karma or Borrowwell.
Absolutely.
And the score is even free there.
Mm-hmm.
So now, do you foresee down the line, Credit Karma or Borrowwell maybe charging you for it?
Absolutely. I think that's their next
They're
step.
just getting themselves established. That would be okay. Let's okay, now section number 2, credit report and credit score basics. Okay, so what is a credit report? A credit report is a summary of your credit history, okay, compiled by Canada's credit bureaus, okay, Equifax, TransUnion, based on information submitted by lenders and other companies such as banks, credit card companies, and telecommunication companies. Okay, so what exactly is your credit report? That's what they're emphasizing it. What is included in your credit report? When you opened each account, how much you owe, whether you make payments on time, okay, whether you miss payments, whether you go over your credit limit. Okay, so these are standard. I mean, like these are nothing out of way that we need to review them. What is a credit score? A number showing how well you use credit. Okay, scale from 300 to 900 points. Okay, on this one, I can just tell you. One of my very good close friends, his credit score is at 900 points. Have you seen that?
Yes.
You have seen exact 900 credit score.
I've seen very, very close to 900.
But have you seen exact 900?
No, not exact 900.
I think so. Yeah, I'll probably ask him to give me a copy of that one, because he said it was. I was very proud to hear from him that his perfect 900. It may be even close, but that's what I will have to get the exact numbers from him. But that's what he was dwelling on. But I have seen. Okay, like so do you see anything above 850 very regularly, or like you?
No, anything over 720, 750 is harder to see.
Above 720.
720, 750 in that range.
Anything above that is harder to see.
Yeah.
So above 750 is not everyone has it.
Yeah, it's the.
Because everyone is having debts or the regular revolving funds are always
absolutely
there. Okay.
And
go ahead.
Sorry, while we're on the topic, see, if you have multiple credit cards, loans, lines of credits, and with the lifestyle that we have in Canada, where you've got work, you've got everything else, it's extremely difficult, or I should say it's almost impossible to not miss one payment in last 6 years.
Oh, okay. Yeah, because and sometimes it is like even recently when we had this Canada Post strikes, your bills were delayed. And you forget which bills are there because you get used to getting bill, you pay, but now the bills are not coming.
Yeah.
So that could be a factor too. I mean, like we do not know how what's going on exactly sometimes.
It's not necessarily, it's not necessarily us sometimes. It's, change of address. It could be, job loss. It could be multiple reasons. So it's missing one payment could be for many different reasons.
Now when you are saying missing a payment, that means it has gone beyond the 30-day mark.
Absolutely.
And I mean, does let's say suppose it has gone beyond 30 days, but it is still within the 90 days. Does that still affect?
It still shows as a late payment.
Oh, okay. And there is something will go down.
Yes.
Okay. Ratings range from poor to excellent or very poor to very good. Okay. No, the ratings range from poor to excellent. That's what we've. Bless you. So they show poor to excellent. Is that right?
The ratings can range on many different. So it's poor. There's fair. There's good.
And then there is excellent.
Yeah.
It is not very poor or very good. No, that is not the one. It ranges from poor to excellent. That's what I have seen most of the time.
Mm-hmm. Yep.
Okay. Best score is 900, but obvious. We have understood that part. Sample credit score from Equifax. Wow. Okay. So they've shown 750. Oh, it's showing very good here. So they have poor, fair, good, very good, and excellent. So between 300 and 600, so they've just kept it at poor, 559 rather. Okay, 300 to 559 poor, 560 to 659 is fair. And okay, now can we get a mortgage when we are in the fair range? 560 to 659.
Yes.
That's a possibility?
That's a possibility.
So anywhere above we can always get 660 to 724 is good. But I mean 560, so you would be requiring more down payment.
Absolutely.
How much would be the standard down payment? 10%?
It depends on many different factors. But I have gotten away with 5% when it's just over 600.
Okay. So it has to cross 600 to get a mortgage.
No, I've gotten mortgages for under 600 as well. Okay. But that's when you need a bigger down payment. So 10% or more.
Okay.
But just over 600 it becomes a little easier. Over 650 it becomes
much easier.
Much easier.
Okay, so there is hope when even the credit score is at 560.
And my suggestion always is not to just go with a number, because sometimes it's just small fixes that help boost the score enough.
Yeah, that is where your expertise comes in over for repairing the credit score. So when we are on this particular topic, let me give you a very big heads up here regarding our mortgage broker, an expert there. Let me guide you with two of his websites, and let me take you there for a moment. So this is our mortgage expert there. I call him par excellence mortgage broker, Faisal Garcia. That's his website. You can go there, faisalgarcia.com, and you can be in touch with him directly. And also he has another one, which is Credit Repair Now. And that is where he is an expert in fixing your credit. So if you are somewhere in the 560 mark, be in touch with him, and he may you may require a small fix, and get on board and get the mortgage approval done. Okay, so back to our power presentation again. So let's go. Okay, your loan risk rating. Okay, so your credit score is 750 or higher, is better than 52% of the Canadian consumer. Again, let's go slow on this one. Your credit score of 750 is better than 52% of Canadian consumers. So I mean, are they emphasizing half of the public has 750 or more?
Yes.
Really? So we are doing. That means we are doing good.
Canadian love to pay their debts on time.
Yes. Yes, that is true, because I mean, we have understood the cycle.
Yeah.
And we are very careful with everyone. So basically, the larger set of population is doing good, 750 and above.
Yes. Most credit scores that I see are average or above.
Average or above. So you are seeing like 750 plus is not like it's not outside of the realm.
Anything over 680 plus, you get premium rates.
Wonderful. Okay, so 680 is the cutoff mark. Huh?
Cutoff mark. So if we can, like, and most credit scores that we see, they're 680 or above. There are some that are below, but that's not the norm.
And you were also telling, like, once it crosses the 680 mark, then you may have more leverage to get them approved for a higher amount.
Absolutely. That's when the calculations give you a bit of more leverage.
Oh, can you again highlight these calculation TDS, GDS? Yes, go ahead.
So TDS,
anything below 680 and above 680.
Yeah, TDS and GDS is the two numbers that we calculate: total debt service ratio, gross debt service ratio. These are just jargons, not to worry about them so much. Below 680, you're looking at 3542. 35 as your housing cost, 35% of your income, and 42% is the total cost. Versus if your score is 680 or above, you're allowed to go up to 39% as housing cost, and 44% of your total income.
So from 35 they go to 39.
Yeah.
And from 42 they go to 44.
Exactly.
Awesome. So you are getting more leverage there in getting a higher amount qualified if your credit score is above 680. Now, in the end, like, if it falls below 600 or just at 600, then is there any other number for GDS, TDS? Or no. These are the 680 would be the cutoff.
3542 or 3944, and 680 is the cutoff.
Okay, wonderful. Okay, so now let's head to the next one. Okay, your credit score, and that is how there you are here. Your credit ranks higher than this much number of population. Your credit worthiness is fair, so that's what they will. How are your credit report and credit score used? Determine if you are a high or low risk for credit. Set the interest rate you will be charged. Yes, that is very important. So determine if you are high or low risk, but obvious those numbers and the interest rate. Now, let me get a heads up. What would be the interest rate difference? How much interest rates? Let's say suppose someone is below 680 and someone goes past the 680 mark.
Not a whole lot different, sir.
Okay.
I would not suggest. From time to time, I get this question that should I wait for my credit score to go higher before I buy a property?
Okay.
My suggestion is no.
No, because even by that time, the prices of the property may have risen more than the difference in the interest rate.
That's one.
Mm-hmm.
That's one very good reason.
Mm-hmm.
Another is you're looking at you're expecting a future score to be better than today. Who knows that will be the case?
It could even go down.
It could go down. You
Oh,
miss
okay.
one payment and there you go.
Okay, it could be different. Okay, so it is better to get it addressed in case if you're in the market to get it as soon as possible. Okay, set your credit limit. Okay, what do they? How are your credit report and credit score used? Yes, I mean last time we had a discussion on this one that they were wanting you to only use between 35% up to 35%, and you were saying you can go all the way up to 50%. So between 35 and 50, is that the credit limit they are talking about? Set your credit limit.
Set your credit limit is essentially what it's trying to say, from what I understand, at least from the interpretation there. Some banks will increase your credit card limit. They'll
Yes,
have
yes, I think.
yeah. So where when you sign their document, it says automatically that every year or every month there will be a revision and will keep increasing the credit score. Credit limit. That's what it's referring to.
Okay.
Where it says set your credit limit. You don't need any more than 5,000. Set that up and inform the bank that you don't want any more.
Oh, okay. So
that's what it means.
But I mean, like, see, what happens is banks take their own time. Like after every 1 year or 2 years, I mean, if you are like a good pay on payment schedule, they will increase your credit limit. What's the harm of increasing the credit limit?
When you increase the credit limit, there's no real harm. But one thing is there is a soft check. System does a soft check every time there is a credit limit increase. Number two is having a higher limit is also a higher risk. Let's say you have a credit card that is 20,000.
Okay.
You lost it
for
any rhyme or reason. It's a bigger dollar amount for you to
someone misusing it.
Yes.
Okay. So if you have like a range that is what you would like to have it, just keep it at that.
Yeah.
That would be better. Oh, that now it makes sense with exactly what are they wanting to say. Set your credit limit.
Mm-hmm.
Okay. Consider you for rental housing or a job. Yes, this was the last big discussion that we had last time, that these days your credit report and score has become an integral part of you getting a rental. In a rental housing, yes, in the rental application, most of the people would like you what your credit score is, and in the job also. Now job has also come as a factor in there.
Mm-hmm.
Okay. How much you pay for insurance? What do they exactly mean for in some provinces? What do you mean by how much you pay for insurance with like a credit score? And what kind of insurance are they talking here?
It could be health, it could be life, it could be vehicle, any sort of insurance. One of the things I have seen is and this happened to a friend of mine who applied for a car insurance, and he got approved with very good rate, but he also had very good credit. And the other friend, who's also very similar age, very close in fact, a couple months apart, and the other friend did not get approved as easily, but they also had not so good credit. There was underwriting required, and so on and so forth. So I'm not sure if that had any impact to it, but one thing insurance companies look for is responsibleness. Like there's a responsible factor, and having good credit does show you as a responsible candidate.
Okay, let me understand. I mean, we are paying the insurance companies, and if we stop paying, they will take cut off that insurance.
Yeah.
So how does the credit score or report would affect?
A responsible person will not get into an accident as much as irresponsible person on the road, which means higher payout.
Oh, they're going in a different direction to. Wow. Okay, so they're like because these are like someone's driving can be a mess, and his financial could be completely great.
Yeah, but I think it's I'm sure some statistics is being used.
Okay.
Someone someone who's responsible in their finances, chances of them not being responsible on
Not
road
being erratic or some. Okay.
yeah,
So that's
like at least they won't have certain things, for instance, drink and drive, or I don't know, there's many things you could look at, and every company or every institution looks at things differently. Things that you and I look at are much different in a way someone else could look at.
Oh, okay. How much you pay for insurance, and that is they've emphasized in some provinces. Okay. Personal information. Okay. Okay. This is what they use: name, address, phone numbers, date of birth, social insurance number, employment. So that is the only like 5-6 things that are there that they use. Have you seen anything else apart from this? I mean, name, address.
I've also seen AKA from time to time.
Okay.
For instance, let's say, and this happens in certain cultures where their name means something else in English culture,
Okay.
in English, and therefore it will say, for instance, for argument's sake, some Asian name, AKA
Okay.
John.
Okay.
So that is something I've seen that I can point out. But yeah, name, age, date of birth, address, employment. Yeah, these things are there. But that's pretty much it. Nothing.
Nothing apart from all these 5-6.
Yeah, nothing that really stands out at the moment. Anyways.
Okay. Credit history, credit accounts and transactions, mobile phone accounts, negative banking information. What do they mean by negative banking information?
Bank accounts that are left with no balances but have monthly fee go out, or write a bad check.
Someone misusing your banking.
It could be misusing or fees incurring and not paying attention to those fees and having the account closed.
Okay. Negative banking information, public records and registered items. So what exactly they want to emphasize with public records?
Public records could be multiple things. One of the most common public record is having a car loan.
Oh, okay.
Yeah, that's a public record.
Okay.
So that is one of them. Another major one, which is not seen often, is FRO, Family Responsibility Office payments.
Okay, so the child support and families
spousal support, any court orders, things along those lines.
And registered items. So that means the liens and things like that.
Yes, registered. So the auto loan will fall in public records and registered items. But yeah, it's something where there is a loan that is being registered on a it could be an auto, it could be a mobile home, things. Yeah, so things that are of security value.
Okay. Debt sent to collection agencies, but obvious.
Yes.
They have, that is where the entire emphasis is on. Credit check by lenders. Okay. And on the credit check issue, we can highlight that one, like without having your consent, you cannot do a credit check.
Absolutely.
Absolutely a must that you have to have your credit check. So we had gone debt sent to collection agencies, credit check by lenders. Let's see, statements and alerts. What do you mean? What statements are they talking here?
These are things that are case by case.
Okay.
But statements that essentially say that if someone has had identity theft,
Oh.
or
Okay.
or a statement like where the client chooses to have their phone number on the credit bureau, because you're allowed to have that, where a lender has to call the client and confirm that they've applied for X product and make sure that the client is in agreement, because they've had some sort of issue in the past.
Now, on the phone numbers, I mean, which phone number are they taking? They're taking the home phone number, or they're taking the cell phone number, or the office phone number? What exactly? How are they working on?
Any number client wants it to be.
But I mean, in case if we haven't given them anything, what number are they like mainly starting from?
That would be a hard question to answer.
Okay, because in a house you can have 4 or 5 people with the same phone number.
Yes.
So they okay. So that is still.
It would be case by case, or whatever client has chose to put that on.
Okay. Sample credit history, Equifax. Okay, so this is, let me see if I can zoom this particular one. Okay, no, this stays as it is. So basically this is like an Equifax credit report and credit and in our last PDF, that is what we had highlighted, that if you can go and review that sample credit history, they have gone and explained paragraph by paragraph. Most of the time they have been able to rip it apart and walk you through exactly how to go through this line by line. So I will leave it at that. And how long does information stay on your credit report? It varies according to the type of information, province or territory, and credit bureau. Okay. Varies according to type. How long does it stay? I mean, from the our general discussion on this one had been like it stays between 3 years and 6 years, and so that is what they may be meaning, and it could vary from province or territories. That could be the other highlight, and credit bureau. So, but the credit bureaus are only 2. So between the 2, they may have a different criteria of collecting those.
Absolutely. They, in fact, both credit bureaus, TransUnion and Equifax, they both seem to have a bit of different guidelines.
Oh, okay.
So, and that is that. Let's just say it's for Ontario. If they've got a bit of different guidelines, I don't think it's surprising for us to picture that they may have different guidelines for different provinces.
Different provinces can have different guidelines. Okay, makes sense. Let's head to the next part. Examples. Negative information about credit card and loan 6 years. Yeah, we have already covered that one. Credit check by lenders. Equifax 3 years, TransUnion 6 years. Oh, interesting. What do you have to say about this one?
Sorry?
Let me...
If I can see the slide again.
Credit checks by lenders. Equifax for 3 years and TransUnion 6 years.
That does not surprise me. It's these both have different guidelines. So, and Equifax is used a lot by most lenders. TransUnion is used by not as many lenders. Them having certain numbers, because in 3 years, if lots of lenders are using Equifax, the list will be quite long.
So when they are saying credit check by lenders, that means if a lender has checked your credit score now, it goes away after 3 years.
Yeah, it drops off from the inquiry search.
Okay. And TransUnion will hold on to it for 6 years just to
to have as a record
okay.
that it was checked by X institution.
Okay, may not have any emphasis there. Okay. Yeah. We are almost nearing our end, so another 2 slides more left and we'll call it a day after that. Bankruptcy stays for 6 or 7 years. Your input on bankruptcies?
I would strongly suggest 7 years, and that is first bankruptcy.
Oh, okay.
If it is a second one,
okay,
it's even longer.
And what time are we talking here?
I've heard 14.
Okay, let me ask this question. So basically, you've had your first bankruptcy, you got discharged, you went and picked up some credit, and then you again filed bankruptcy?
Yes.
Oh, how many times you can do that?
You know what? It's a question I've always had, and I've never gotten a straightforward answer to it. But I have seen double bankruptcy.
And getting a mortgage or any loan after that will be quite a task.
It's challenging. However, not to say that it's not possible, number one. Number two, you have a lot to prove after that. And if it is explained well as to why and how with proof and so on, it's not difficult to go through that process. For instance, I've had the client who was double bankrupt. The first time was a relationship breakup, and the second partner of that candidate fully took advantage of them. And the second time when it happened, it was because of injury at work.
Oh, okay. So both were very reasonable ones.
Exactly.
Okay.
And when that is the case, lenders are more than willing to understand, as long as we have some sort of proof to show that was the case.
Okay.
And if you're hospitalized for a month or 2 months, usually you have a proof. If you've gone through a breakup or something of that sort, it's usually court papers, divorce, separation agreement, something of that sort. There's something there.
Make it substantiate. What exactly are you
Absolutely.
doing there? Okay. Calculating your credit score. Payment history. So that's what goes on into when they are trying to calculate. So payment history makes sense. Like how well you pay within 30 days, 60 days, 90 days, or you go above. Use of available credit. Okay, how you use your credit that has been given to you. Okay, use of available credit. What exactly are they wanting to get into this one? What does use of available credit means?
This is exactly what we were touching last time. 35%, 50%, 90%. Okay. If you have a credit card that is $5,000 and if you're using $4,900, that's
okay,
quite a bit.
You don't max them out.
Yeah.
Okay, don't max them out. Okay. Length of credit history, very important. So that's what we were discussing last time. It gets established. Apart from after first 6 months, it gets established and takes an establishment for around 2 years. Is that right?
Absolutely.
So that would be the length of time. That is what they are harping on this particular one.
Just on this topic, I would like to touch that if you are new to the country, that is there is an exception for it. So, or you have a reason why you have never developed a credit history. There's always a way to go about it.
Okay, so let's say suppose someone has just come new to the country, and they just go and then they have a good down payment to purchase a property. Then will they get a mortgage? I mean, right away?
There are programs. It's called newcomers mortgage.
Yes,
So
that
there
is
are
true.
there are alternate credits. There's multiple things. Every credit problem has a solution.
Okay, and what kind of a down payment are we talking for a newcomer?
There are programs with 5%, 10%.
There are. You can get away with 5% if you have good work, job letter, and established. Okay, makes sense. Wonderful. Good to know. Okay, number of credit checks. Okay, and yes, this is a question that has been asked another number of times. What exactly is a number of credit checks? I mean, at every credit check there is a drop, or like a few of them are free, that there is no going down on the credit score. What do you have to say on this one?
So let's just say if someone wants to apply for a line of credit and they go to big 5 banks within a week period, their credit score does take a hit, but it's not as bad as having a credit check today, a month later another one, a month later another one, a month later another one. Because when you have credit checks in a short period of time at multiple places, that says that you're looking for a product. You're looking for an approval. So that does not affect your credit as bad as having checks every 2 weeks or every month, because then you are a credit seeker. You keep asking for credit over and over and over.
Okay. Let me understand it from a different point of view. Is, let's say suppose someone goes and does one credit check in a year. Will there be a drop in his credit score?
Absolutely.
Yes?
Yes. Anywhere between 6 to 10 points.
Even for the first one?
Yes.
So immaterial, like I mean, we had heard, like if you do up to 6, there's no drop in a year. That's not the case.
No. Every time there is a credit check, there is some effect to the score.
There is some effect to the score. So basically, it is better to pull out your own credit report and show it to someone who's wanting to see your credit for loan procuring, instead of doing a credit check.
See, the lender still has to do their own credit search, but it does avoid lenders to, keep doing searches like every lender
unnecessarily. Yes. Yeah. Okay, that makes sense. Okay, so I mean, I was under the notion that a few of them are free, but that's not the case.
Yeah. No. I would expect no. That's not the case.
Okay. Types of credit. Okay, this is what we have discussed. We have had an elaborate discussion on this one. Like you should have your credit cards, your line of credit, and your loans. And are we? Am I right on this types of credit?
Yes.
Okay. Next one is payment history. What can damage your credit score? Okay, I think so. This would be probably our second last one. That's where late payments, missed payments, makes sense. Debt sent to collection agency but obvious. So if you have a late payment, there is a damage. If you have missed payments, okay. But I mean, there was some reading that I was doing on missed payments, that if you call the lender and come up with some kind of arrangement, then do they take care of it? Like, or how does it go about it?
Essentially, they give you a bit of a break on it.
So they won't be reporting it.
I cannot say that for certain.
Okay.
Because at the end of the day, it's the lender that decides. They may report it, but they may also say that the client has made an effort, or a payment arrangement has been put in place, or things along those lines.
Oh, okay. So
At least it's not as bad as, no, this client is not paying.
Okay. Bankruptcy, but obvious, that will damage your payments withheld because of a dispute. This is very, very important, and we had highlighted it even last time. In case if you are in a dispute, pay it off and then try to go after it. That will make more sense.
Absolutely.
And what happens if it's a very large amount and then you have no recourse of getting that amount back? Should you keep on paying minimum payments, and what do you do?
I would say, yeah, minimum. Start making minimum payments at least. Keep making minimum payments, and then you keep fighting it out to.
Because sometimes like you have some rogue lender on the other side, and he's going to run away with your money. Then what do you do?
Absolutely.
Okay. Yeah, that would be much better way to getting it redressed. Keep on paying low payments, so it. Okay, so that brings us to the halfway mark for understanding a workshop on credit score and reports, and we're almost touching 1 hour and more. So we will call it a day today, and we are like wishing everyone many happy holidays to all of you, and bringing 2018 to an year end. And we will be back again in 2019, and with the same putting all these webinars together and with less glitches. I hope so. Go ahead, your thought on that.
On this whole workshop that we've done, one thing I would like to say to our clients and audience is it is your credit score. Handle with care.
Yes, it is very important. Right? Yes, every one of us get touched by the credit score and report. So you have to be you have to have the know-how and take care.
And it is something that is not taught in our schooling system. So we have to essentially learn, our ways.
Yes.
And so these webinars are designed for us to even, give more education and understanding. And credit reports touch you and your life in more than one ways.
Yes, and just to answer you on that particular one, it is for this same reason that I deviated, because this was a very they had given a small brief on step number 3, that you need to review your credit report and score, and then there was a full articles on those ones, and I figured it out like, no, this is equally, it's good to deviate from it, get this addressed, and the main thing here is we got a lot of good assistance with that PDF last time we did on understanding, and this time also on the power presentation with the workshop on this one, and the rest we will cover it next time. So happy holidays and season's greetings to each and every one of you, and we will be back in January 7th of 2019. That would be a Monday, and 2 weeks off. So again, greatly appreciate all your time and efforts, Faisal. You have been a great help in addressing this nuances of this, because we were only going to read it out. You had put a live experience on that one, so that was really amazing, and grateful to you for that.
Sir, what you are doing in this, bringing the knowledge, is something that doesn't exist. It's very hard for someone to put this together. So even though we have these system glitches, at the end of the day, it's more education than we ever had.
I appreciate that. Really appreciate. So let's call it a day on this great news. Great note, and we will be in touch again in the new year.
Yes.
Thank you, sir.
Thank you again.
Thank you again. Thank you.
Thank you. Bye-bye.
Bye.